racial disparities in student loan debt. And I think one of the areas that we have been most championing or trying to get the message across is that whereas we see these figures that the average student who finished school in 2016 or 2017 had about $37,000, when you break down those numbers, about 70% of those students finished with less than $10,000 and about 2% with more than $50,000. And so we have the conversation shift a little bit to talking about, well, maybe there's not a student debt crisis, but maybe there's a repayment crisis. And so what we've really been discovering in our research is that for certain populations, in particular Black youth and young adults, that maybe it's not a question of either or, but both, that there's a student debt crisis and a repayment crisis for certain demographics. And understanding the drivers that are leading to higher debt accumulation as well as the drivers that are leading to high rates of defaults within particular populations. And so I think we can unpack that a little bit over the next next hour or so as to why is it within this particular population do we see these such high debt accumulation and problems with repayment upon school leaving, either with a degree or without a degree. In particular, entrance into the labor market, and particular, labor market discrimination, underemployment, and unemployment for this population.
Yeah, and at the risk of having total consensus early on in the panel, I think the student debt crisis, such as it exists, is particularly acute for communities of color and working class communities. And my concern, and there's, I think, it's important to talk about the 1.4 trillion. It's important to talk about the 37,000 because I think those are, issues in and of themselves, whether or not they're sort of impacting the broader economy. At some point, 1.4 trillion becomes 2.4 becomes, it's like that's an issue we should probably, not totally dismiss, but. Where people are really struggling with student loan debt, the people that are struggling with student loan debt are really struggling with student loan debt. Half of all Black student borrowers default on their loans within 12 years of starting college. That's a crisis, right? That is a problem. The policy mechanism to fix that can be sort of debated and can be different depending on where you are and whether it's the federal or state level. But that's a crisis. 1/3 of Pell Grant recipients who borrow default on their loans within 12 years of starting college. And my major concern about student debt, again, isn't the average or the aggregate necessarily. It's that the people who are in crisis in student debt are making up more and more of the new student population. Students of color made up about 1 in 6 students in 1980 of the college. They made up 1/6 of the college-going population. Now they make up about half, right? So if the students that are entering college are the ones who are more likely to struggle to repay debt, the problem is not going to go away and is probably going to get worse. And I just think student debt, whether it's sort of we isolate it as an issue in itself, it is bumping up against massive disparities in the labor market, rising costs of childcare, rising costs of housing in certain areas, and it is contributing to a racial wealth gap that does grow at each education level, right? It is true that there are massive returns to a college degree, and within race, you are typically much better off getting an education than not getting an education, but across race, it actually, the racial wealth gap grows at every education level, right? To the point where the typical white household headed by a high school dropout has more wealth than a Black college-educated household. And student debt is a part of that, answer, given that students of color have to take on more debt or borrow more often. But we should really be thinking about what, the system that's sort of predicated on taking on debt is doing to sort of a yawning racial wealth gap.
So yes, a lot of agreement and a lot of focus on the individual students as opposed to the aggregate. And there are a lot of points that I think we're going to want to come back to in what you said. But I do, Jason, you said it's not a macroeconomic problem. But I'm going to push you a little bit on that because we all keep reading about how, the economy is going to crash because of student debt? What if people don't pay it back? Are people not buying houses? Are people not retiring? Are people not getting married and having children because of student debt? And I think it's very difficult for people to interpret these things. Like, you read the headline, right? And somebody did a study and says something about home ownership. How should we think about that? And one of my fundamental questions about this research is, what's the comparison point? Right. I mean, is it like student debt? I mean, we all know that, we'd be better off if you have the same education and the same income, you'd be happier if you didn't have to make student loans. But you probably wouldn't if you didn't make those student loans. So how can we think about that?
Right. So I think you, again, just partly answered the question, but thank you for leading me to the answer. So that's, if you're thinking of buying a house, we don't even need to do any studies here. Let's just do a little bit of intuition. You're thinking about buying a house, and you make, let's call it, $5,000 a month, and you have a lot of student debt, and somebody else makes $5,000 a month and has a little student debt. Which of them is more likely to be able to buy a house, take out the mortgage? Obviously, it's the one with the less student debt. I don't think, though, that's the most interesting question, because the question is often student debt plus college, or no student debt and no college. So now let's ask the question of, you have two people. One of them makes $2,000 a month more than the other person because they went to college, and that's not an unreasonable number. In fact, it's probably conservative. And they pay $300 a month in interest on student loans that the other one doesn't have to pay because they didn't go to college. Who's more likely to be able to afford a home and own a home? The person who makes $2,000 more and has to pay $300 in interest, or the other person? It's definitely the first person, not the second person. So a lot of these studies really do come down to what the counterfactual is. And in general, owning a home, if you make more, you'll be in a better position to own a home. And if you go to college and you complete college, you will generally be in a position to earn more. So I think that's a really important lesson from all of this. Even actually college students with and without student debt have similar rates of home ownership by 35. The other thing going on in some of these studies is going to college itself has a causal impact. If you go to college, you will more likely get married later, you'll have children later, you'll be in a position where you want to own a home later. That's true, with or without student debt. So you also want to make sure that you're not conflating the causal effect of going to college with the causal effect of the debt, which happens to be very correlated with going to college.
But people who pose this question aren't really thinking they don't want people to go to college. They're thinking they want somebody else to pay more so that students won't have to borrow so much, right? Like, so what if we, say, raised taxes so students wouldn't have to borrow as much? What impact would that have?
I think at that point you're talking about a distributional question to some degree. And yes, it would be nice to have higher taxes and more subsidies for school. Where would you do that? Would I make it lower interest rates on student loans across the board, so the person who goes to medical school, isn't paying as much interest? That might help the person who went to medical school's home ownership, but probably isn't the most progressive way to reorient the tax code.
Mark Fenaba, does either of you want to comment on this question?
Yeah, I mean, I think a couple of things. One, I think the counterfactual is important, right? And I think we should be careful about robust investment and Pell Grants that meet the rising cost of attendance, right? I mean, the Pell has atrophied to the point where it covers about 29% of the total cost of attendance now, when sort of in the early 80s it was closer to 70%, right? So I think that's important, and that can sort of plunge subsidies towards the students who have the most unmet need and who are most likely to struggle with debt in the first place. And the only other thing I would say is that the income boost to a college degree is in many ways exactly that. It's the income boost to a degree. And to the extent that rising student loan debt for some students is either preventing them from going at all, whether there's a debt-averse population or a population that cites student loan debt as a reason they did not complete a degree, that makes it sort of a counterproductive system. So, I mean,
Can I briefly insert one thing? I mean, I think part of the answer to all of that might be that people have less debt. I think part of the answer to that might be scaring people a little bit less about debt. And I worry that some of the conversation deters some people from making an investment that is a really good and wise investment for them to be making. So, so I think we need to be a little bit careful sometimes with the way we talk about this.
Yes, I'll just say that I think some of the long-term effects of the student loan crisis are still yet to be seen, especially since young or older millennials are now in their late 30s or moving up into their 40s. I'm part of that group, so I can say that. And so they are the demographic, the cohort that have experienced this high rate of student loan debt. And so to really know what the long-term effects are, we still have to, we're studying them, we're following them. Some of the work I've done is looked at the effects in the marriage market and seeing some delays there for women. But I will say that if we, when we start parsing and looking within, by demographics, when we think about the short term for these populations that are defaulting on their loans, we should be a little bit concerned if this is going to have credit market effects, is going to go on your credit report, it's going to have implications for your ability to purchase a home later on down the road. So I think, we can also frame this in a way that we think about what are we seeing in the short term with regard to the populations that are not paying or having problems paying on their loans and then don't have that degree, and so they're having problems probably securing a job or a stable career, and then are having that has implications for their ability to pay back on these loans that are then also having ripple effects onto their credit and their ability to make those purchases in the long term, even as a family. Mark for thinking about the implications for family and for future family planning and so forth. So that's some of the things we think about, and and as I said, when I started off, thinking about how we are still following and tracking what the long-term implications of this student loan crisis is for this recent cohort of young adults.
Did you want to comment on that? Okay. So, you've talked, both of you, Mark and Fenaba, talked about the differences, the racial differences, and in borrowing patterns and how specific groups of students are having issues. But Fenaba, we'd really like to know more about, Black students have much higher debt levels than other students with similar levels of education, right? And even much higher Hispanic students borrow at more typical.
Trying to show that this narrative around racialized processes that happen before a student enters college, processes that happen during the college process and upon school leaving, right? So, sorry, my mic went out. Is that better? Yes. Hello, hi. So, as I said, what's happening before the young adult enters college? We think about family. Social and economic resources are really important as far as helping children to navigate those processes. And if we look at income inequality, wealth inequality in particular, the ability to assist your child with, as families have taken on an increasing share of college costs, not only are they taking on loans, but families have also had to help supplement those costs, throughout the college process. And we just have such large or vast racial wealth inequality in this country that I'll give an example. In our data, for the top quintile, the wealth quintile, was to qualify for the top wealth quintile, you had to have at least $191,000, and only 3.6% of that particular quintile was composed of Black families. So the distributions are just completely off, right? As far as we're like the median of the Black wealth distribution. So the ability to transfer funds, or the fungibility of being able to transfer assets to help support young adults I think is one of the critical mechanisms through which inequalities in debt are happening. And what we see when we look at what's going on while young adults are in school, Black students are often funneled or pushed towards predatory credit markets, so more likely to take on and have private loans. So we saw a rise in private loans across all races during and after the Great Recession, but the numbers were significantly higher for Black families.
as well as we see them more likely or disproportionately represented in the for-profit schooling industry, which has, as we know, and students that go to for-profit schools are much more likely to have higher student loans. And then when we look at, if we see them upon school leaving, obviously we would like for students to finish college with a degree, but we even see disparities amongst, and Mark touched upon this a little bit, as far as the markets that they're entering. So Black college students with degrees are much more likely to be underemployed or unemployed longer. So we really find, and some of the research that we're finding is that not being able to hit the ground running and pay back those debts as soon as you finish college matters for the rates of student loan, the trajectories of debt across young adulthood, right? So if you don't pay it off quickly, we see among whites, their trajectory is going down, whereas the trajectory for student loan payments is rather stagnant or not moving that much at all. So, lots of, I think, we can see processes before and during and upon school leaving that are really contributing to this chasm as far as the student loan, that's contributing to the ability of Black students to not accumulate so much wealth, and then the inability to pay it off at the same rate as their white counterparts.
Jason, Mark, do you want to comment on that?
I hope an important theme of today is that there's a lot of heterogeneity. There's heterogeneity of how students do in terms of whether they complete, whether they end up with a lot of debt, and some of that is systematic, racial. Some of that is just chance. Some people end up getting a great job and making a lot. Some people end up not, getting a great job and make a lot less. And so hopefully we'll talk about income-driven repayment. I think heterogeneity of institutions is another important one. And if we talk about a set of institutions and we do 95% of our conversation is about for-profit, that would be totally appropriate and totally right. And you want to get at the quality of the bottom tail, not worrying as much about everything else. I said 95% because I do think that asking tough questions about HBCUs should be another 5% of the conversation. I can tell you whenever we did analysis in the White House of college scorecard or value added or any other measure, a lot of HBCUs would end up towards the bottom of whatever it was we did, and I don't think we were, went out of our way to push that type of a narrative or that type of analysis, because there was certain awkwardness around all of that. And these are places that tend to be very expensive, that tend to not have great outcomes. That's not across the board, et cetera. But I do think understanding, why that is, just making sure we understand it and talk about it and start to address it should be a part of the conversation as well.
Can I just say I'll preface this by saying I'm by no means a HBCU expert, but I think yes, Blacks, they tend to be highly underfunded and have very low endowments compared to non-HBCUs universities. But I also know that HBCUs produce a large percentage of graduates that go on to complete PhDs. So, as a PhD, as a PhD graduate and someone who is very aware of the dearth of Blacks in higher ed, I think that they do serve a purpose as far as continuing to create this pipeline for, especially in the STEM fields. They are very, they produce some of the largest numbers of Blacks that go on to complete a PhD in our society. So, as I said, I'm not, I don't want to, go down that road. But the issue there is they are expensive, and they also they can't provide the same number of grants and non-loan aid that non-HBCUs have, just because their endowments are significantly smaller than, so the largest, I believe the university, the HBCUs with the largest endowment is Howard University, and their endowment is smaller than the 10th non-HBCU and granting university, which is University of Michigan. So that just gives you some perspective on the differences in the abilities of these universities to provide the same amount of support that other universities, non-HBCUs, are able to provide.
Right. And I'm definitely not an expert on this topic, and I don't think this is the big issue, but I think it's an issue that may be a little bit under-discussed. This isn't about closing schools, certainly not. The endowment thing, I think, is a good point, but from the perspective of a student, I think what we want to do is take a hard, headed look at how much does it cost, how much more do you make because you went there, how likely are you to default, and from the perspective of the student, you sort of don't really care why it is that that's the case. From the perspective of public policy, the government certainly couldn't be doing something about endowments. Should that encourage people who went to those schools to give more or something like that? Maybe, but I do think in terms of caring about the students, let's look, how much does it cost? What do you get? When you look at those numbers, tend to tell you that this is not one of the better deals in higher education.
Yeah, I'd say a couple things. Oh my God, I can use them. Cool. I feel like I'm on a talk show, just like doing the pass on the microphone. Two things. One on the institution side, and I think it's important to not paint to look at the differences by institution. I think that's super important. Often when we talk about college outcomes, we talk about outcomes, right? Or accountability, we talk about outcomes. We talk about sort of repayment rates, default rates, and earnings. Although we really only measure students on one of those, or institutions on one of those. There is a sweet spot, and there's a growing body of research from Raj Chetty and his team at the Equality of Opportunity Project around the institutions that are both doing the lion's share of taking on working class students and students of color and providing good outcomes, right? And I think there's a lot to learn from those institutions, both in terms of earnings and outcomes within student loans. So we should really look at both, right? On Feneba's points broadly, I think I will throw out an area of, or beg an area of further research that I think someone in this room, all of you look smart, you should consider doing, because we've looked at it and it's sort of hard to get at. But that's issues of parents helping students repay or borrowers repay their student loans, or providing them financial assistance when they would otherwise be falling behind on loans. I think sort of like intergenerational transfer of resources is super important. Tom Shapiro, anyone who knows his work, he calls it sort of transformative assets. Those financial sort of benefits that are passed down through your family that sort of help you move up or help you be upwardly mobile. And there's a decent amount of research showing that families of color are much more likely, when they get out of college and sort of see that income and wealth boost, they are providing resources to older family, right? White people tend to sort of transfer wealth down. People of color tend to transfer wealth up, right? And how that fits into a conversation around student loans when people of color are more likely to take on debt and more likely to struggle with debt, and how much that's contributing to it.
So this whole issue of debt and the notion of a debt crisis seems to have been a significant factor in feeding the discussion about we should have debt-free college, right? And it's interesting because, of course, there's a long way between astronomical debt and zero debt. But both debt-free and free have become sort of notions that are getting a lot of attention. Mark, can you help us with what is, first of all, the difference? Because I think there's a lot of confusion about that. And also, what is the response? I mean, people who object to this mostly are not saying, we're not at all worried about student debt, but they are saying that many of the programs that now exist maybe target resources ineffectively and could, in the end, hurt low-income students. So can you just clarify all this?
No, I'd be happy to. So I think the best way I can think about the difference between tuition-free and debt-free college is that tuition-free takes tuition off the table for students at public 2- or 4-year colleges, depending on how you're designing the program. Debt-free college takes unmet financial need off the table. Tuition-free, and obviously it depends on the design, and we've seen, very we've seen differences in design across sort of, programs cropping up over the past couple of years, but also recently I see Jen Mashori in the crowd. She did a fantastic paper for Century on this, so everyone go read it. But tuition-free tends to be a flat benefit, whereas debt-free you can sort of scale up and down, sort of the income spectrum as to what subsidies students can get. And I think I'm partial to one, and that will become clear, but, there are advantages to both, right? The tuition-free college movement is sort of, the strengths of it are that it's simple. It might provide a more durable political constituency. There's less bureaucracy, frankly, probably with the tuition-free model, and there are some sort of benefits of promise programs, whether they're community college or otherwise, that help keep students from leaving financial aid money on the table. So it's sort of provides an ability of students. If you have to apply for financial aid. There is a certain subset of students who are not applying for financial aid now and are getting stuff that they otherwise wouldn't get, but they've always been sort of eligible for. Like I said, debt-free college, the concept of it, and again, policy design matters, but it covers unmet need. It would take the full cost of attendance into account. But like I said, obviously at the top end of the income spectrum or the wealth spectrum, you can tweak any subsidies you provide to wealthy households or not provide any, right? Like I often say that wealthy households have debt-free public college now if they choose to have it. I think the Sandy, as you mentioned, there's sort of a difference in policy design in some of these. Whether a program whether it's tuition-free program that's first dollar or last dollar, whether it's taking into account all of the aid you get before you get the subsidy and only covering tuition, or taking tuition off the table first and allowing you to use Pell for living expenses, very much matters. But I think the sort of the idea behind debt-free, which I'm obviously very partial to, for anyone who's talked to me about this over the past few years, is that it really is just a return to saying you are deciding to attend higher education. You have an expected family contribution. Maybe we're going to say maybe you can work 10 hours a week, and that should be the total of your sort of financial obligation for college, right? It's sort of the promise of the Pell Grant that it's going to level the playing field between people who don't have the resources to pay for college now, right? So it's we use the term debt-free, and it sounds like we're saying eliminate all student debt, but it's really about getting rid of unmet financial need at the outset.
So can I just, for clarification, one thing is you said in your trying to give advantages to the other side that tuition-free limited the bureaucracy, and that makes me think like we have to differentiate, don't we, between let's eliminate tuition, and then if you apply for financial aid for your living expenses, great, and the last dollar programs you talked about, which bureaucratically you still got to get everybody to get their aid ahead of time. So. And then the other thing is that the debt-free, like the Clinton's first proposal was debt-free tuition, right? So that's different from what you described, right?
Yes, her first proposal, and then the later on, and then the bills we've seen in Congress, I would say have an improvement in that they take into account the full cost of attendance, because we know people are borrowing for much more than just tuition. I mean, at a 2-year college, tuition makes up 20% of the total cost of attendance, right? So that's where I think, only looking at the tuition side of the ledger falls down. And I should say the tuition-free could reduce bureaucracy, right? If you're eliminating tuition, initially. A last dollar program sort of keeps, the same, bureaucracy in place. I think I think obviously, like I said, sort of policy design matters here, and I think making sure that any new resources, whether at the state or federal level, flow to the students with unmet need, or flow, frankly, to, we were talking about institutions, resource-starved colleges, so that colleges don't get an unfunded mandate, right? I think that, I've talked to community college leaders where they're very on board with the concept of, frankly, making sure that their students, have no financial need at the end of the day, but don't want to be, sort of mandated that they do that without new resources. So we need to put new resources into it. And I will say that we're not. I think that the evolution of this discussion has actually been really helpful. Bernie Sanders has introduced a tuition-free college bill for many years before this became sort of prime time. A prime time spot on the sort of political agenda, but it wasn't until last year, after sort of, I would say, good advocacy, but like a robust discussion, that his bill was actually improved to make sure that all people who got, I believe, the maximum Pell Grant had all of their unmet need funded, right? So, even those that had been talking about tuition free sort of realized that, there's more to college costs than that.
Jason?
I had the misfortune of waking up at 5 in the morning today to go on TV, and then got a stream of questions about the deficit. And so I'm like in a slightly deficit frame of mind, a little grumpy about all of it. I think there's a lot of things we'd like to do, like a ton of things within the college space, but also preschool and paid leave and infrastructure and maintain robust Social Security benefits and not reduce Medicare a lot, et cetera, all of which I sympathize with. We're a country that doesn't want to raise taxes on anyone except people at half of us want to raise them on people at the very top. The other half doesn't want to raise them on anyone. So I do think we have to think a little bit about a budget constraint, number one. Number two, I think there's a little bit of a fairness question, which is, do you want to think about somebody's resources ex ante when they go to college, what their resources are, what their family's resources are? Or do you want to think of their resources over the course of a lifetime or ex post? So, somebody doesn't have a lot of money when they show up at college, they make a ton of money. Should that person be paying more for college than a similarly situated person who exits and doesn't make a lot of money? That would be point two. Third is just from an efficiency point of view, there is a cost of spending a year of your life sort of sitting in classrooms and not a year working, and you probably do want some mechanism to take that cost into account. All three of those considerations, the fiscal consideration, the fairness about ex ante income versus lifetime income, and the wanting people to take into account the efficiency, lead me much more towards an income-driven repayment type of model, where if this investment pays off for you, you will repay the cost of the investment. And if this investment does not work out for you, then you won't have to. And I think that, in sort of all three of those dimensions is probably a better way to go. We've made a lot of improvements in that regard. We're at 6 million people now. I think within our system we could stand to simplify it a decent amount more. And, ideally, in my dreams, move to a more Australian type of system where it's automatic, it's everyone, and it's really simple because it just shows up on your tax return with everything else.
Can I ask you to elaborate a little bit on your efficiency point? Because even if tuition is free, people are still spending a year of their life, right? So what exactly do you mean, and what would make people realize that more?
I think in effect, what income-driven repayment says is that spending a year of my life doing this is you have to pay the costs of, all the wonderful people that are teaching you. You have to pay for your housing and food, and you have the opportunity cost of not working. In some sense, you have all of that incurred. Now, that will end up being waived if the bet doesn't work out for you. If you do, I don't know exactly how debt-free works, but the more you're covering not just the cost of the wonderful people teaching you, but a set of other living costs associated with doing that for a year, the more you're saying, you don't need to take those costs into account. And I think it's worth thinking about them, and but thinking about them in a way that. So I think one problem is heterogeneity. By the way, the other problem I think is a cash flow problem, which is that you have to pay these costs at a time when you don't have much cash, and so using income-driven repayment and loans to solve that cash flow problem and liquidity constraint, as opposed to we want to, as a society, be transferring on net to people who are going to college, relative to what we're doing today in a world of budget constraints, et cetera.
Fenner, did you want to comment?
So now we have some differences.
I don't think I necessarily disagree with some of the proposals that Jason is talking about. I think, again, thinking about it from this lens of disparities in debt, we just also want to think about whether or not in the policy prescription, whether or not the policy is going to create a system that is going to, in which the inequality is going to persist, or instead it's going to be targeted so that we're closing the disparities upon school leaving, right? So I think we have to think about both income repayment programs, but also what is going on in the labor market, that people are not getting the returns to their degree, and are having difficulty finding work that will allow them to have an income that will that allow them to pay back these loans over a shorter period of time, or that won't increase the likelihood that they will default. So basically, in the program, is the prescription also going to decrease debt repayment disparities? And I think in an ideal world, if we think about that, would be what we would like to see, right? So not just a program that's going to maintain the status quo of some populations are just going to be more burdened or have to have a higher likelihood of default, but can we build something into the system that's going to decrease the likelihood that, if you have fallen on hard times, you're going to be more likely to default, or your inability to pay is going to be penalized.
Right. And just to be clear, if everyone was in income-driven repayment, you did it right, there would be no more default. You wouldn't default because if you did it the Australian way, it would be collected on your taxes and be collected in a non-burdensome way. And if it became burdensome, you wouldn't have to pay it, and it would eventually get forgiven. So I do agree the status quo would be a terrible thing to maintain. The question is, what's the alternative to it?
Yeah, and I think I think income-driven repayment is great. I think it's many more people should be in it probably now than there currently are, particularly those on the sort of lower end of the income spectrum who could be making low to no payments from a monthly perspective. I think it obviously should be simplified. We have too many income-driven repayment plans, and that's an opportunity for HEA. There are 8 million defaults right now, though, and I think we have to grapple with who those people are and what we could be doing about them right now. If enrolling all of them in IDR is solves some of the problem, where do the other sort of solutions come from? And delinquency rates on student loans have been basically the same for the past 5 or 6 years, even as delinquency rates have fallen for other types of debt. The only thing I'd like to say about IDR, which again I think is a good, worthwhile program, because it's income sensitive, and there are good reasons why it's income sensitive and doesn't take into account wealth. You don't want someone having to sell their house to pay off their student loans. It sort of ignores the racial wealth gap. And sorry to sound like a broken record on this, but like white households making $50,000 have a very different wealth profile than households of color making $50,000, right? And there's a different likelihood that some are going to be taking care of older family, as I said. And I don't think, I think some of this problem is solvable through the repayment system, and to the extent there are people who are defaulting and would not because they sort of could be in a better repayment plan, we should run, not walk, to make sure that those people are enrolled in something that they're eligible for, and we should run, not walk, to make servicers sort of accountable for that. But I don't know that we can fully solve it through the repayment system, given all the sort of disparities Fenaba and I have talked about. So I don't disagree with that. I think that it's one solution to the problem.
So I wanted to pick up on one of your comments, Fenaba, and emphasize the importance of, you talked about reducing the inequality of resources, and you talked about it mostly in the repayment process. But I think in the discussion about free tuition, particularly the last dollar free tuition programs, in a sense, I mean, one of my big things is this is like undoing the Pell Grant. We've spent so many years trying to use the Pell Grant as a way to not eliminate, obviously, inequality of resources, but to give larger subsidies to people who are really without resources and to reduce inequality of resources. And if you say everybody gets, we're just going to add to the Pell Grant and make sure everybody gets the subsidy of the amount of tuition, you're saying, we're eliminating the progressivity of the Pell Grant program. And so I think focusing on what we're trying to get at as the inequality of resources and how that is reflected in inequality of opportunities is something for us all to remember. I want us to talk more about policy, but first I want to ask you one more question. As you talked about sort of the different groups and the problems that people face, a lot of the problem, and people have been talking about this a lot, is, you know, students don't complete, students go to the wrong institutions, et cetera. Is this a debt crisis or is it an education crisis? Is the problem that people are not getting the education and succeeding with the education that we're hoping for, and that's why they struggle with debt? Is that a different way of looking at it, or would that help us to focus there, or what are the shortcomings, the risks of focusing there?
Oh.
Whoever wants to start.
Probably not what you want to hear, but
It's fine.
it's probably a little bit of both. And I even go further and say it's also a labor market crisis as well. Because these are all the different markets that, eventually these students we're hoping are being prepared to enter into a labor market that's going to receive them and pay them wages where they can get that return on that education and that investment, right? So like Jason said earlier, we're asking individuals to take 4 to 6 years out of remove themselves from the labor market, invest in themselves in the hopes that they're going to get some return on that investment over the rest of their lives, right? So if that investment in themselves or that time or that 4 to 6 year period is not of the quality, or one that is not one in which they're going to receive the returns or adequate returns for the cost of pursuing or taking themselves out of the labor market, then there's a problem there, right? And we're asking students to do this at a cost that has increased dramatically over the last 20 to 30 years, right? So the cost of doing so, of removing yourself from the labor market, is high, and for some students, they're not getting the returns on that investment. So yeah, both, I would say, both plus labor.
I agree with that. I think there's a wealth crisis, there's a labor market crisis, there's an I talk about it in terms of an affordability crisis, right? But all of these things contribute to the student loan problem. Like the rubber hits the road when someone is repaying their student loans because of disparities in family wealth and disparities of borrowing rates and disparities of the types of institutions and the resources that they have, or the institutions that sort of market to certain students. So all of this sort of this is a totally unsatisfying answer, but we need to sort of tackle all of these things if we care about student debt. Student debt is sort of a function of a lot of these things.
I think a lot of this is very much a function of an education set of issues, and now to make sure we're hitting the 95% target for for-profits. That's where a lot of these problems are, and that lends itself not to a solution about how you handle tuition or how you handle debt or how you handle income-driven repayment, any of those issues. It says regulate those institutions, and that's something, obviously, that the Obama administration did, and I think some of that has contributed to the decline in enrollment in that sector, and that's a good thing, and maybe to some improvements within that sector. I'm less sure about whether or not that's happening. I think a second issue, which has a really big bearing on both whether you're going to repay your debt and what your earnings are, is whether you're completing college. And so an emphasis and a focus on that, I think, is really important. Don't make me do 3 more sentences on it, but many other people could do that. The last thing I said is I'm very sympathetic to all of these policies being interdependent. I also worked in government for 8 years, and I had the experience that we would put out plans on lots and lots of different things, and sometimes not every single part of every plan would happen. And so I do think it's worth asking the question of, if you don't fix all the other things, what would you do in this space, even while you're trying to fix all the other things? And I think, you look at our labor market, I think there's a lot of things we need. I think we need stronger, voice for workers. I think we need a higher minimum wage. I think we need more vigorous antitrust, not dealing with issues of monopsony and labor markets, non-compete, et cetera. I'm way in favor of all of that. Even if we don't do that, if we get the education policy issues right, we get the student financing issues right, you'll have more people who are in a position that they graduate from college, and at the height of the recession, the unemployment rate for college graduates rose to the point where it was still below the unemployment rate at the very best point for non-college graduates. So I think that gets you a really far way, even without solving everything else, and obviously would not want to slow down on solving everything else as well.
So that's really helpful in terms of policy.
Did we cheat? Did we get ahead of where your
No,
script
you didn't
was?
cheat.
Okay.
You saved, because we do want to move to the audience, but I would like to get the other two people to also comment concretely on policy recommendations.
Yeah.
Mine is really brief, and I just am going to piggyback on what you just said, is that honestly we want to promote college completion, right? That's, even if you look at the different, the returns to a college degree, even though they may be lower for blacks, those who finish and have the degree have higher wages than those who do not. So I'm not in disagreement there.
Yeah, not at all. I think the two things I'd say about completion. I think it gets us some of the way there. Again, I'm going to broken record this again, but black college grads are 5 times more likely to default on their loans than white college grads. They're 4 times more likely to be 60 days late on a loan payment. So, again, completion matters. It is huge. Within race, again, it is hugely positive for net worth, but it does not sort of close gaps. One thing about completion is that there's a vast body of research showing that there's a really, really positive impacts of need-based grant aid on college completion, right? So we should really be focusing on increasing need-based grant aid and making sure the Pell Grant is sort of, to Sandy's point earlier, sort of the promise of Pell, that it equalizes sort of college opportunity, and that does cover a meaningful amount of the total cost of attendance at public or private institutions. I think that regulating bad actors in the system is hugely important. I think the Obama administration was right on that. I think that's something that is massively important for some of the worst outcomes, right? But I would like us to sort of think about if college completion is our goal, and it should be one of our goals, right? There's one sort of surefire way to get there, and that's provide sort of financial support and other supports to students who are least likely to complete now.
Thank you. Okay, let's open it up to the audience. Please identify yourselves when you ask a question.
Hi, I'm Frank Baum with NASGAP, the National Association of State Student Grant Aid Programs, and this has been a great panel and so many different topics I could ask a question on, but since we're talking about student debt crisis, to me, the crisis isn't news. I graduated from college many, many, many years ago with $12,000 in debt, which doesn't sound like much, but adjusted for inflation, that's $50,000. And I remember my monthly payments, except I had 3 of them. But the point I wanted to make is loan counseling was much better then, because when I signed my promissory notes, there's truth in lending disclosure on them. I knew what my monthly payment was going to be, and I couldn't just click through screens. I had to sit through a class and understand. And Bill's turning on because I went to University of Pennsylvania, and they had great entrance and exit counseling. But state programs today actually a lot of times have things like what Senator Harkin called verification of comprehension, where you have your entrance counseling, and then there's, in some of our cases, a test at the end. So you'd have to say, yes, this is a loan. I know what my interest rate is, and I know what income-based repayment is, because as you guys have inferred, the default rate should be 0, because you can have income-based repayment with a payment of 0 and ultimately get your loans forgiven. But the other thing that Jason kind of touched on is, with my loans, interest rates are much higher, and we're in a historically low interest rate environment. So if you look at where interest rates could be in 2 or 3 years, interest rates go up 2-3%, and you're adding $75+ to a monthly payment, so things could get a lot worse. So I'm curious what you guys would say about improving loan counseling to make sure people understand this is a loan, you have other options, and think about what your monthly payment's going to be, and can you afford this?
I mean, it's hard to be against that. I just genuinely don't know how much it would or wouldn't make a difference, what the cost of it would be, but it sounds like a good idea. And then your point on interest rates, I think that's spot on, both within student debt and more broadly in the economy. And you're sort of right. I should have, raised that at the beginning. as a real risk that's built into the system.
Yeah, I mean, again, I think it's very hard to argue against good sort of loan counseling at the front end or the back end. I don't know that we're going to financial education our way out of this problem, right? The research on financial education is somewhat spotty on how much it sort of impacts, people's bottom line at the end of the day. But yes, sure. I mean, obviously, to the extent there are people who don't know they're taking on loans or don't know the terms or whatever, and then get caught later not understanding, like that's a problem for the individual. Yeah, that's what I would say.
That's what I would have said as well. It also kind of shifts the narrative back onto the person when we're seeing a lot of more systemic issues with regard to the default. So that's an individual level solution, which I agree with my panel mates that it's not discouraged. And I would say even like anecdotally at my university, we're encouraging students to take, we have an increase in these classes, both in the front end and the back end before you graduate, about what counseling them on what to expect when you finish with regard to paying back your student debt. So that's happening. But at least it's happening at my university. But I don't know if it's going to necessarily change the inequalities or disparities that we're seeing as far as and the rates of default at a higher level.
One thing I just wanted to mention on the interest rates, right, is that I think that's a really good point. I think one of the things we've sort of danced around in this on this discussion, or gets danced around in the broader discussion around the student debt problem, is the psychological impact of having your balance grow even as you're making payments. And again, there's massive racial disparities in the ability to pay off $1 in principal on your student loan debt. So to the extent that your monthly debt to income ratio might be okay in an income-driven repayment system because you have a low payment, is that having a psychological impact on people who say, I had maybe $20,000 when I graduated, it is now ballooned to $35,000 many years later. I've been making payments, and it's not a monthly crisis for me, but what are they not doing instead? To either save in other areas, sort of build assets, build wealth, or pay down other debts, right? I think we can't sort of overlook the psychological impact of the interest killing you, for lack of a better term.
Right. I'm torn because I think the psychological point is a very real one. On the other hand, as a rational basis, if you're buying an asset that pays out over 40 years and that has a disproportionate amount of that repayment in year 10 through year 40, not in year 0 through year 10, the idea that you want to match your debt to your assets in general with any business. And so I think what we want is sort of knowing that that's the right way to finance things actually is in a pretty backloaded way. Is there some way to map that in so it doesn't mess with the psychology? And is that maybe defaulting everyone into something, having it administered through a tax return, having it reported in a different way? I know exactly what it is, but I don't want to go entirely to the rational thing at the expense of everyone's mental well-being, but I don't want to cater to everyone's mental well-being by continuing to perpetuate a system where assets and debts are really badly mismatched in a way that I think is adverse to a good financial decision.
Hi, Ryan Bandari. I actually work with Third Way on the economic team. And I just wanted to talk about the college cost factor. So if you, from an outside perspective, I'm not an education expert, but if you think about what happened to costs at college, and it's like, obviously, the demand for, degrees shot up. You have then colleges who are seeing this increase in demand, seeing their applications surge, and recognizing as market actors, hey, we can increase the price for this because, one, we know that the payoff is there, and two, that they're going to pay for it. They want this, and then of course the cherry on top is that the government will give you the money no matter what. Is that so they can keep Harvard could charge $100,000 and you can get a student loan for, however much you need to pay for it. So they know that the money is going to be there for the students. And then, of course, to minimize, social outcry, they don't do it all at once, but they gradually increase a couple thousand year after year. So I guess the question is, one, is it wrong, morally that they're responding as market actors? And then two, if it is wrong, what can you do about it to fight costs from that angle?
Go ahead.
So I don't care about Harvard, but, and I shouldn't say that, there's a Harvard professor on my panel, I just realized that. It's a great school. But so, you're essentially outlining the Bennett hypothesis, right? And I think we should be extremely careful in painting with a broad brush across institutions. 4 out of every 10 college students is at a community college. Community colleges are spending less per student, or around the same that they were per student about 20 years ago. Their costs have gone up entirely as a function of state disinvestment, in some cases local disinvestment in higher ed. So that, and frankly, in many cases, that's, they're educating the students that we care about who are most likely to struggle with debt. And community college debt, we talk about, student debt is sort of a relatively new phenomenon. Community college debt is an extremely new phenomenon, right? Like, most community college students don't borrow for college, but if you want the associate's degree, you have about a 1 in 2 chance of taking on debt to get that. That's a pretty radical shift in how we finance it. So, this is sort of a punt on your question, but I think at many, many, many institutions which are doing the lion's share of educating the students that I frankly care about, that is not really what's happening. There are some institutions, obviously, that are sort of responding to a market in the way you're talking about. I think that probably happens at the for-profit sector a very decent amount. There's sort of research showing that, and maybe among elite privates, but I think we should be careful with that.
Are you going to comment on that, Jason?
I don't set Harvard's tuition, but I think there's a compelling argument for raising it to $1 million and having, 98% of the students not have to pay full freight. And that's some of the direction that universities have gone in, and some of that I think is probably a good thing, and then gets a little bit distorted if you're looking at headline tuition rather than what people are actually paying. We keep being tempted to broaden this out. I certainly think if you look at something like the growth of health costs in our economy, that's put a big squeeze on state budgets. That in turn put a big squeeze on higher education budgets, and that in turn translates into increases. So doing something about the growth of health spending might do as much to solve some of these tuition problems as fewer climbing walls or lazy rivers or whatever the other solutions people have are.
Yeah, let me just say 2 of my co-authors on the Trends in College Pricing Report are sitting in the front row here. We have spent many years trying to get information about net price, not just sticker price, out there. And it's complicated, right? So it's not a simple headline. But I just to reiterate, I don't care about Harvard either, in the sense of that's not where the problem is. But there is a lot of feeling in Congress, I think, about looking at the sticker prices of these schools. And they, of course, all want their kids to go to Harvard, right? So that's what they really care about. But if you ask who would be helped if Harvard had lower sticker price, where, they obviously have very generous financial aid, it would only be people who have incomes high enough to pay that price. So I don't know about the $1 million, but I think somehow we do have to really focus on how are students paying, and on how can we make a system that is inevitably going to be complex, one that people can navigate and understand and becomes a little bit more straightforward, but targets the subsidies in the right place.
Jim from Third Way. I don't care about Harvard either.
It's a real theme of the panel.
Yes. Although they have that great little dim sum bun place right there by the Kennedy School that's fantastic. So when Third Way first started getting involved, thinking about higher education, I remember sitting with a group of people that, experts in higher education, and I asked this question. I said, when a kid doesn't graduate from college, is it the student's fault or the school's fault? And it stumped everybody around the table. And what I'm wondering is, you talked about income-based repayments. Is there a way to model either loan repayments or income-based repayments or some other way of financing higher education in which the college is vested in a greater degree in both the student graduating and the student getting employed and getting a good job? Are those interests not aligned at this point, and is there a way to align them? And I'm thinking also, particularly like minority students, is there a way to do it in which gender and race are taking, it factors in a positive way?
I think that's a great question, and I think if somebody had a specific proposal, I'd want to look at it and ask two questions. You give the institution more skin in the game. You penalize them for people that don't complete, or you make them bear a portion of the cost of the default, or whatever it is. And then I'd always want to ask the question of, on the one hand, that gives them an incentive to get people to complete. On the other hand, it gives them an incentive not to enroll black people or whoever it is they think is more likely to default. And have you risk adjusted it in the right way, et cetera. And I always get very, very nervous when I look at those things, because I think, as well-intentioned as we are, if we don't get all the risk adjustment, et cetera, right, you create a set of perverse incentives. That being said, I'd be open-minded, but I'd want it to run a gauntlet of a lot of tough questions.
Yeah, that's exactly what I would want to caution about is how might it affect the acceptance of particular populations who they fear have a higher risk based on some metrics that they use that they probably would not directly tie to race, but probably some other indicators that would flag, them as an increased risk of not completing the degree. So it's hard, that's, yeah.
Thirded. We only judge institutions or programs now based on, not only, but only one of the ways is default rates, and that is, I think, there's massive consensus, frankly, across the political spectrum that that's not, the only measure, or even, in some cases, a useful measure for measuring institutions. So there's many ways you could do it, and probably, there's a model to do it where there are better metrics to use. I would say that we cannot exclude, the institutions, the student population that they're serving. And frankly, we talk about, accountability in terms of penalties all the time, and making institutions sort of pay a percentage of loan defaults or sort of a percentage of their loan balance in some cases, in some proposals. But providing institutions a bonus that are doing a good job, I think, is hugely important. Again, there's a subset of institutions that are doing both enrolling students of color and low-income students and that have really tremendous outcomes in the labor market, and they're not always the institutions you would expect.
I want to push a little bit on this because I think that this question is really relevant for some of the policies that are very much on the table, both about risk sharing in student loans and about, as you talked about, regulation of institutions and thresholds. And I've sort of, gone out there and ventured to say we really do need to say, as you said, tackle the schools at the bottom. And if you're not graduating students and they are defaulting on their loans and they're not repaying their loans and they're not making any money afterwards, this is a problem. So if you risk adjust in order to prevent low income or African American or any other groups of students from being discriminated against about this, how do you avoid the problem of low expectations? Sort of all of our students that we enrolled had all these risk factors, and we only expected 15% of them to graduate, and look, 18% graduated. But so that's great. How do we really improve outcomes for those students, and what kind of policy proposals would really be constructive? Is there an answer to this?
I think that's a great question.
Thank you. Okay. So
Sorry.
You're not in Congress and you don't have to write the bill, right? Does anybody, I worry about this a lot.
I used to just ask James Cavall, but he's not on the panel, so
Right. Okay.
wherever he is.
Okay. I don't know if anybody has thoughts about this, but I worry about this all the time. I just feel like, okay, so I'm going to ask another question on because we're talking about the loan stuff, and very much on the table now is the question of what about loan forgiveness and what about graduate students, right? Cutting back graduate student loans or letting them borrow infinitely and getting their loans forgiven. What should we do about that? Any thoughts?
I'm pretty certain that the rates of default are lower for graduate students, so that just is kind of like shifting the narrative of the student loan crisis to one where there's not really, or should I say repayment crisis where there really isn't one. Also the returns for particular graduate degrees, so professional degrees are higher than if you think of maybe master's programs that are not necessarily geared towards law, law, business, or maybe thinking social work or teachers, for example, where those might be the populations that are struggling with their student loan repayment. So thinking again about loan forgiveness programs for those populations who are doing public service, and these programs do exist. So I'm not saying anything that's revolutionary by saying that, but maybe thinking about how we can improve upon those particular programs is definitely something to think about. I'm going to stop there, I think.
Yeah, I think on the loan forgiveness question, I mean, we talked about how income-driven repayment could certainly reduce defaults among some populations. Another way to reduce, given what we know about the balances of the borrowers defaulting, another way to reduce or eliminate default in a large majority of cases is just to do a one-time debt jubilee of like $5,000, right? If the average amount in default is $5,000, we could think about doing that. Now, that's not necessarily a long-term solution, but that's, we should probably be more creative about loan forgiveness than we are in terms of like, all or nothing at 10 years in public service, or all or nothing at 20 or 25 or 30 years for undergrad and grad debt. But I think, obviously the crisis such as it exists tends to be among undergraduate debt, and it tends to be among working class students and students of color. So that's where we should think about loan forgiveness, and it's okay to target policy mechanisms there.
Nothing to add?
Hi, so Wesley from Third Way. First, I would say I think the GAO report that just came out yesterday on Grad Plus loans, I think said the default rate was like 2%. I haven't read it all, but I think that's an important point to make. But Sandy, you were kind of getting to this. But so when we think about the risk-sharing plans, there are at least 2 bills out there right now. I'm curious as to what you would think, how you should risk adjust in those policies.
I feel like I asked that question and nobody would.
Right. Look, I mean,
there's a difference, though. I mean, yes, in improving their outcomes, but also just in general, how would you risk adjust on the front end?
Right. I mean, it's not health insurance, right? I mean, health insurance, it's a travesty if you set up some system that leads people to not want sick people to come into their hospital or into their health insurance plan. Here, Sandy's point in the question was some people going to college, going to higher education may make some sense, and for other people it may not. And so, the normal way we think about this and worry about it, at least in other spheres, doesn't fully apply here. On the other hand, even people who are riskier may, on average, or may 40% of them benefit or 60% of them benefit, and you sort of don't want to lose that while getting rid of the other part too. So I don't think it's as simple as no risk adjustment, and if it doesn't, if we think you're going to have a higher default rate, you shouldn't go. And then there's also the last question: is how much the institution can affect. They can affect a lot who they're letting in. How much? Is it the student's fault, or is it the institution's fault? I don't know the answer to that question either, but I don't think there's an infinite amount the institution can do in terms of completion and in terms of earnings and repayment afterwards. So, are you giving someone a lot of liability for something they don't have? They have a limited amount of control over.
Yeah, I think, again, I don't know the sweet spot of how you risk adjust. I mean, people have been talking about this, smarter people than I have been talking about this for a very long time. I think one area that we don't often talk about risk adjusting is the amount of per student public funding institutions get, right? So if an institution, and you can even take research money out of the equation, but if a community college is getting, $1,000 per student in public funding, that's something you should risk adjust on because they're just getting fewer resources to educate, again, the most needy students, right? So that's one area that we should think about in terms of accountability.
Okay.
So, Bill Andreessen with University of Pennsylvania. I care a little bit about Harvard. There's an article in the Wall Street Journal yesterday about this significant amount of financial aid that some universities give for merit, for students who don't need financial aid. In some cases, they're upper income students, but the universities have devoted a significant amount of their grant portfolio to luring in these students who, for whatever reason, they think it helps the image of the university to bring in high-performing students. Is there a public policy role that we ought to be playing here to focus to do something about increasing the amount of need-based aid as opposed to the amount of, one university was like 50% of their student aid is going to merit scholarships. What should policymakers be doing in that area?
I mean, there's certainly a bit of a negative externality to that, and that you're just competing over a fixed set of students, and one person getting a student means another institution isn't. In that type of situation where there's a collective action issue, there can be a role for public policy. On the other hand, what that policy would be seems pretty hard for me to imagine. So I don't know, so maybe there's some role for naming, shaming, having it just, and the like. But then you look at sports. It's not like you're going to tell institutions they can't do things to try to attract people that are higher than average quality in athletics. So maybe, I should be even less concerned about the academic part when we have so much going on the athletic part. So yeah, but I think maybe raising awareness seems like probably the right thing to do.
There have been some higher ed scholars like Sarah Goldrick-Grab who actually pinpointed that as being an issue as far as the amount of aid that goes to these merit-based scholarships when they could be redirected to families that need it. So I think it has been proposed by some as far as like the structure of that program or what that would look like. I think is still hasn't really been discussed in detail. So I think awareness, like everyone else is saying, awareness that this is something that's going on in certain schools. I'm not sure how widespread that particular issue is, but if it's something that's diverting resources away from families that need it, then it should be looked at and addressed more systemically.
Yeah, I think just a couple of additional thoughts because I agree. One, in some cases, not all, but particularly at public institutions, the shift to merit aid or the shift to massive enrollment of out-of-state students who are paying out-of-state tuition, or the shift to students who are just paying more and are being sort of induced with a small coupon to come, is some of that's a function of state disinvestment in some states. So their institutions are just trying to make up for lost investment in their institutions. Yeah, and then I think the thing I would say, and I think the policy mechanism isn't necessarily out there, but there's nothing stopping the federal government from creating a matching program for institutions that say the more you spend on need-based aid, the more we will kick in and match some of that, right? So that could create sort of a virtuous cycle on that, on that issue as well.
Let me just add to that I think we can be very much in favor of need-based aid and opposed to aid to students without need, but asking the federal government to get involved in that, I think we should be really careful about thinking that the federal government could effectively do anything about that. And one issue is that, of course, the schools, it's not, Harvard, again, is not giving non-need-based aid. It is schools that are having trouble because they don't have enough students who can pay the full price, and therefore they need to attract some students who will give them some revenues. It's a very complicated situation, and to me, the federal government sort of making rules about that would probably make us worse off. So we need to find other strategies for getting institutions motivated to do the right thing. I think we have time for one more question. Somebody have a... Okay, why don't we just ask people to have final thoughts, if any?
Sure. I'll conclude by saying I think what we see as a student loan crisis is for certain populations, especially Black young adults, is both a student debt and repayment crisis, and one that we believe is going to be contributing to ongoing racial wealth disparities, as Mark has touched upon for this recent cohort of young adults. And I think the fact that families are increasingly having to shoulder a larger share of college costs makes this not just a young adult issue, but a family and intergenerational issue. And I think comprehensive policies that address this and take it from that lens are necessary. So I think I'm glad to be here and that we are addressing this student debt crisis and repayment crisis for Black young adults. But I think we have to have these ongoing dialogues to talk about what it means for families who are sending their children to school, because it's not a singular student issue, but one that is impacting families in their entirety. So yeah, I'll stop there.
Yeah, I think, look, I mean, one of the few agreements you can find across race and class is that people want their kids to be able to go to college and get a college education and do better than them. And I think, where we see massive sort of racial disparities and class disparities in student loan repayment, or just the amount of debt people are taking on, or student debt's inability to get, people, or hindering people's ability to get ahead or achieve the American dream, or what do you want to say? All of those things are related to other factors in the economy, right? There's a massive racial, there are massive racial disparities in the labor market, in housing, in sort of, pick a metric, and there's, structural racism involved. But I would say that, sort of as higher ed focused people, we can do one of two things in that front. We can say this is an issue for other areas to sort of fix, or other policy areas, and we're just sort of we're sort of unlucky. Or we can say, what are we doing in higher education if not trying to close some of these things, right? If higher education is supposed to close gaps and sort of, allow people to be upwardly mobile and not sort of calcify or reinforce disparities that we see in society. I'm very worried that student debt, not necessarily the total amount, but just sort of the existence of it for some communities who have to take on more and are more likely to take it on, are just reinforcing inequality. And that's something we should very much care about.
So I'll just reiterate very briefly, I think focusing on completion, on progressive financing like Pell Grants, on regulation of bad institutions, on income-driven repayment are all really important. But I did want to end on a positive note, which is picking up on something Mark said as well, that I think there are some places here where sort of how do you pay for a scarce resource, and sort of more of this, less of that. But there is some really low-hanging, there's some real positive sum here too. And these institutions that we're better understanding through the work of Raj, John Friedman, and others, of these real engines of opportunity to take students, give them much better outcomes, move them up the income scale. And a lot of people just don't realize that, are going to the wrong schools, are not taking advantage of really great opportunities that are already out there that they could already afford even in the existing system. And remedying, that massive information failure often requires cutting-edge research. We learn new stuff, and they're doing cutting-edge research. But some of it is, rather inexpensive interventions to give people information. So I think sort of kicking all the bad ones to get better, but highlighting, rewarding, making sure people know about, making more accessible the good ones, which is something Mark has talked a lot about, I think is a real positive, good thing for all of us to be thinking about how to do.
So thank you to Third Way for bringing us all together. Thank you to the panelists, and thank you to all of you for coming.